what we've decided to do is kind of break up the moderation for each of those. And so I asked each one of the panelists to take one of those topics and take the lead, frame and set the scene, and then pose a question for the rest of the panel to discuss. What I would say is after we've covered those three topics, we're very open to questions. I see we've got 56 minutes, which is a bit longer than I thought we had. So I think we've got plenty of time for questions, so please do text those in, and we'll pick up all questions at the end. Right, so perhaps we'll start with Tamsyn, if that's all right, to lead us off and open up a discussion on fees.
Hello. So fees have been a really topical subject in the last couple of years. I'd say now that KiwiSaver is getting to a decent size, $50 billion in there, the amount of fees being paid is growing. Last year, I think the New Zealand public paid about $340 million in fees, so roughly $126 per person. One big change that came through this year was we saw all KiwiSaver providers having to put the dollar figure for fees in their annual statements. Obviously that required all providers to come up with one way to present that. And we've also in the last couple of years seen the entry of the entry of new players into the market which have really challenged fees, the likes of Simplicity, who launched in 2016. I'm sure the founder of Simplicity, Sam Stubbs, is well known, and he's been very vocal about high fees in the industry. And more recently, we've seen the likes of Juno, KiwiSaver enter into the market, offering a set fee option for an active management service. From a consumer perspective, it's hard to know how much attention is being paid to fees. Some research has kind of shown that consumers at the moment aren't really choosing based on fees, and recent research by the FMA found that basically less than 1 in 3 people even noticed the change on the annual statements this year to include dollar fees. But like it or not, fees are here to stay, and they do have a big impact on what people have in their retirement savings at the end. So the question I would like to put to my fellow panel members is, $50 billion in KiwiSaver seems to be a sizable amount. So when can we start seeing fees come down? Maybe David, you'd like to start?
Thank you. Nothing like being thrown the first hand grenade, if you like. Look, we don't spend an awful amount of time thinking too much about whether our fees are necessarily too high or too low relative to everybody else. I think at the end of the day, competition is very alive and well in New Zealand, and the markets will have a very natural way of ensuring that we are all looking at each other and making sure that we are providing whatever services we are providing for whatever fees that we believe is reasonable to charge. Whenever I think about the whole fees issue, I'm always reminded of an expression, and I'm unsure exactly as to who I should ascribe this to, but cost is always an issue, or only an issue, in the absence of value. So I think whatever a provider wants to charge, the onus is on them to constantly be aware of what services they are providing and to ensure that they are checking in that those services are reasonably priced and that they are delivering value relative to that, and rely on the fact that if they are not comfortable to be able to go through that analysis, eventually the marketplace will find out for themselves whether or not that value has been delivered. And that just underlines the challenge that face all of us. Because when you look at fees across the board, I've always thought about 0.25% as your baseline number for just providing the core administrative services and giving people access to the markets. On top of that, if you want to get into the active space, I think it's reasonable to charge anything up to about another 0.5% or 0.25% to 0.5% on top of that, depending on how far you want to go. And then for ourselves, we've embedded advice into that process, so anywhere between 0.25% and 0.5% as well is also reasonable. So if you add those three components up, you're between 75 basis points and 125 basis points. and depending on which components of that you want to put in there. I'm going to touch a bit later on in terms of where unlisted investments sit in this space. But if you are serious about using KiwiSaver money to support small to medium-sized businesses in New Zealand, sustainable investing, responsible investing, innovation, that doesn't come cheap. If you want to go out and put some money from a KiwiSaver fund into a typical private equity fund, you are faced with a 2% cost up front. That business model doesn't work in a KiwiSaver space where a reasonable fee is deemed to be 1%. So there are challenges, and anyone who's serious about getting into that space cannot afford to be a part of that space if you're only charging a very low commoditised fee.
Thanks. Yesterday, the Minister mentioned that fees are going to come under the spotlight next year when there's the default provider review comes up again. So that's obviously a potential time for more pressure to be put on providers. Thérèse, what do you think is going to happen as part of that review? Do you think we will see default provider fees come down again?
Well, I think for me, I get somewhat frustrated with the fee debate because I think a lot of this is around focusing on one single item in relation to KiwiSaver or any funds, to be honest with you. So what you're talking about here is not comparing apples with apples, because when we're talking about fees and we're comparing ourselves to international standards, largely you're talking about wholesale fund management fee and the differential between passive management and active management. And then on top of that, you've got an administration service fee. And there's a huge confusion in the market between those two and what you can expect to get from those. So from a fee perspective, I get frustrated because I feel that no two providers are equal. They have different offerings, and the three factors that are determinative on a good retirement outcome are the fund you choose, the level you contribute, and the fees are a factor in there. But 42% of New Zealanders are not contributing at all. So let's put the debate where it actually needs to occur in terms of what's good for New Zealand. Having said that, the debate is there, and as you say, it's not going away. I think it is likely that there'll be further downward pressure on fees through the default review, but let's look at that in terms of where it's at right now. Most providers have whatever fees they like on the other funds, not just the default fund. So if there's going to be a real discussion around fees across KiwiSaver, it should be encompassing at least a debate around the charges for the other funds within KiwiSaver, not just default, because there is so much pressure on members to choose the right funds and move out of default into a fund that's more suitable to their needs.
I'd just like to pick up on one of those points. I'd echo what was said there. I'd also expand and say the most important thing for a member is dollars in their hand at the time of withdrawal, whether that is at time of retirement or whether it is a first home withdrawal. It's all about dollars in the hand. And there are several aspects to that. And Thérèse has touched on some of those, which is, are you in the right fund for your age and stage in life? And has your provider helped you into that by providing advice? But it's also about after fees and tax returns, right? And it's important to look at that whole equation there, after fees and tax returns. So as well as fees, there's also the returns aspect, and there's also the tax aspect. Now, tax isn't a particularly interesting topic. Most people will switch off and go to sleep. I'm not sure if Anthony Edmonds is in the room because he might be the only person who would stay awake with me during this session if he is. But tax is also a huge determinant of returns. And so if, as a provider, you've set up as a low-cost provider, however, you've set up with inefficient tax structure in the way that you're delivering your funds, for instance, through the use of an Aussie unit trust, then there will be a hidden cost associated with that. And that can be, as research has shown us over the last 10 years, a drag on performance of up to 30 to 40 basis points on a growth portfolio. That's a hidden fee, that's a hidden cost. And so you have to look at the whole picture and not just take fees in isolation. There's a real danger that members can be focused in on fees at the exclusion of everything else. And there's a real risk there that you can see members missing out on dollars because they're focusing in on saving on cents. And so you need to look at that whole equation to make certain you're getting the whole picture. And I've talked about tax structure, that's one area. The other thing to think about is, active management we've touched on, and that's not just active management at an asset allocation perspective or stock selection perspective, but also about currency as well. So if you're in a scheme that is not actively managing currency, especially when we've seen the volatility that we've seen recently, that can have a serious impact on returns as well. And so it's worth looking at that whole equation.
But I'll just add also, I agree with everything, Joe, there, but I just think from an industry perspective, disruption is good, and it's important that we recognise that we need disruptors. So people like Sam Stubbs and simplicity, and much as the message is simple in its form, it is important that we recognise this is the way the world is going, that there's downward pressure on fees. And so there is a requirement for us all to use digitisation to be more cognisant of what we're charging customers for, and being really clear so customers can make real choices.
Just further to what I was saying before, at any point in time, an organisation has got choices to make in the fees front, and we, for example, could cut our fees by 20 basis points. We've decided, however, that in terms of taking the longer term picture and supporting New Zealand, that 20 basis points would be far better employed in addressing some of the issues of matching up the massive capital pool that's available in KiwiSaver and seeking out avenues for alternative investment and supporting New Zealand businesses to do that, and that will give our members a much greater return than the 20 basis points that we could save them by just slashing the fees down towards a more simple approach. So I think the onus is on somebody looking at fees as just the main issue, to not work out if they're missing out on anything, if they're getting a cheap fee. They need to understand what exactly are you missing out on if you're paying a low fee, because there's no free lunch in this business.
Yeah, and that moves the focus from fees to value. What is the value that you're receiving? And whether it's after fees and tax returns, or whether it is around the advice or servicing proposition. So as a member, if you fall on hard times and you need to do a financial hardship withdrawal, is somebody going to be there and help you, support you through that process? When you call, do you know that there's somebody there who is experienced, understands, and there is the resources there to help you through? And I think that's really important. Also, the advice proposition. And just to pick up on Thérèse's point, again, I believe disruption is a good thing, and it's going to drive innovation in the industry, and we're starting to see that with advice, and we're starting to see that with robo-advice coming through. And what that does is allow us to scale an advice proposition. And David, you talked about the kind of fee premium for actually including advice. Well, the scalability of robo-advice will allow us to bring that down, and that would lead to fee compression over the long term, I'm sure. To your earlier question, your original question, Tamsyn, I do think we're going to start to see fees come down. I think over the next 12 to 18 months, we'll start to see a pressure on fees, driven either by market forces, driven by providers reaching a certain scale, driven by the default provider review next year. And I think that's just natural, and I think that we all in the industry accept that and embrace that. Okay, so I'm just conscious of time, so perhaps we'll move on to the second topic. We'll pick up questions at the end because I know that there will be plenty. But the second topic was sort of going to be around advice, and perhaps I'll ask Thérèse to lead us off.
Yeah, and I'll ask this question, and you'll know by the way I ask it what I think the answer should be. So KiwiSaver funds are gifted to us by the government. We get contribution tax credits from the government, and there's compulsory employer contributions attached to it. It's systemically important to New Zealand and to New Zealanders, and critically important to the future of our generation and the next generation in New Zealand. Therefore, should it be incumbent upon providers to have services such that they can give advice to members who are in their KiwiSaver scheme? So I'll go first in terms of responding from my own perspective, and David, you can shape up how you want to disagree with me. So my view is that yes, absolutely, the KiwiSaver providers should be required to provide some sort of financial literacy and advice program for members. Right now, the vast majority of people, over 90%, are getting no advice on their KiwiSaver funds. It is a crying shame that we can have 25-year-olds sitting in cash funds for the next 30 to 40 years without any obligation on those who are getting fees from that member to do something with that. I think that with the advent of robo-advice, the changes in the legislation that are coming about present an opportunity to give a much more simplistic and tailored advice programme to members within KiwiSaver. And I think along with the challenge there is on fees, members or providers should just have to assume that their conduct expectations for members within the products for whom they are charging fees is such that they provide an advice service for those members. David.
Yes, no, look, totally agree. I won't add any more to what I noted down here in terms of the two biggest issues facing us that all providers have to really apply their minds to in the advice space, and one of them is the lack of advice that's going out to default members when they join, and not just about the right fund. Very few people understand the whole concept of KiwiSaver in its basic level in terms of contributing, holidays, member tax credits, being on the right tax rate. I shudder to think how many people are sitting in a default fund on a 28% PIR rate who simply just have not been contacted by their provider to let them know, hey, you might be on the wrong rate. So that's big problem number one when it comes to the advice space. The other problem is a brewing problem. It's been mentioned on several times during the conference that the economic cycle is such that we are going to be facing an economic and market downturn sometime in the future. It's just a matter of when. We are ill prepared to deal with that from the perspective of people having enough intervention and processes to provide some sort of stop mechanism between them making an irrational decision to get out of a high growth fund just after a market has fallen temporarily. And I see that being the biggest problem that has to be solved before it happens. And we've got an opportunity to put in place advice processes through robo or whatever mechanism to ensure that people have something that stops them from making that irrational decision.
I think the challenge with advice is that from a consumer perspective, definitely people have a fear of how much it's going to cost them. So I guess, you know, if they're already paying a fee to a KiwiSaver provider, perhaps some of that cost is built in. And so, you know, the advice should come from the provider side. The challenge with that is obviously making it clear to the person that it's, you know, it's not whole of market advice. The provider can only give advice on their funds, and perhaps that's all that's needed at this moment, you know, to get people into the right funds, to get people contributing to their KiwiSaver. But, you know, further down the track, when, you know, people want maybe more on, you know, which provider to be with. I mean, I get that question all the time from people, how do I know which provider to be with? You know, and, you know, we refer them to the, you know, the sorted fund finder tool all the time, but I don't know, I still think it's key at the moment just to get people into the right fund. It's still, KiwiSaver's still early days.
I agree with you completely, and I think that because we have a lot of face-to-face interventions with KiwiSaver members, and to be honest with you, what they're looking for is help in most instances, not just advice, well, not really advice, to be frank with you, just help. What do I need to do with this thing? And until the balances get to somewhere north of about $50,000 or $60,000, you're really not going to have a good debate to be had around full financial planning for those members.
And almost what you see in general is that people aren't even ready for financial advice, proper financial advice, perhaps till, you know, they may be thinking more seriously about retirement.
Yep.
You know, does a 25-year-old really want to have someone mapping out all their finances? They probably have very little to no assets, you know, maybe more debt than assets, more likely. You know, and maybe it is down the track when people's balances have got to a more substantial size that they seek out, you know, the full financial advice side. So.
I think we're in danger of violent agreement here, and I'm I was thinking of the comments Anna made yesterday around PIR and the research that they did, and people's lack of understanding of some basic concepts. Often what people are looking for is not necessarily advice, it's just support, and making certain that we as providers are in place to deliver that. Just to move it on a little bit, what I would say is when we do get to advice, it's not just that people are wary about paying for advice, it's that the model of advice that we as an industry have provided does not resonate with most members of KiwiSaver. So the model of advice of an advisor in suited and booted coming around with a briefcase full of policies, that's not how people operate these days. When we go out and speak to our members, we talk to them about whether that a model of advice, sitting down, speaking face-to-face with an AFA is something they're looking to do, and there are many, many reasons why they don't want to do that. Sometimes they feel intimidated, sometimes they feel that their financial situation is embarrassing and they don't want to discuss it with a stranger, but mostly I would say their model for consuming has changed. People now don't look to an expert to tell them what to do. What they want to do often is to go online and learn for themselves, and they'll learn by playing and learn by doing. So by delivering interactive tools that people can play about with till they start to build up a level of understanding of some of the terms, and then they feel more confident perhaps to sit down and talk to an advisor. But if we continue to try to push the historic model of advice, not only will it be unsuccessful because of the cost associated, it'll be unsuccessful because people just won't want to take it up.
Yeah, I think though there's still we're still relatively infantile in terms of moving towards any form of digitised advice for KiwiSaver members. We're finding that the vast majority of our KiwiSaver members want a human being. It's not your traditional booted and suited advisor. It might be Yvonne in her gold glittery top. So it is a more informal type of an interaction, but despite all the digital tools and avatars and help tools that we have built, they are still looking for a human being to give them the confidence around where they're going to. That will change, absolutely change with time, and we as an industry need to move with our customers. But I think for us to assume that KiwiSaver consumers will just use digital in the next 5 years, I think, is probably overestimating it.
And what I would say there is it's not either or. I think people will need to be able to move seamlessly between channels. I think you'll find a lot of people will start working things out for themselves digitally, and then they'll reach a point where either their needs become more complex, or they reach a stage there where they feel more confident to want to talk to somebody, or they get to a point where they don't understand, right? And at that stage, they need to be able to escalate out of the digital environment and speak to a human advisor. So we as providers have to have that capability available, and that's where KiwiSaver providers who don't have an advice proposition, I think, are setting themselves up for an issue further down the line, because there is these what will start as technical queries will move on to become advice questions at some point, and if there is not an online advice proposition supported by a human advice proposition, then we'll be failing our membership.
Totally agree. As I said, the next brewing downturn is going to be a true test for that, and if providers have not got a solution in place for that potential problem down the track, we are going to be doing New Zealanders a massive disservice. If there's nothing to stop them from switching out of a high growth fund when the market falls 10-20% into a conservative fund and locking themselves into that for the rest of their lives, we know from long-term evidence that the value of some sort of advice process that holds people's hands in those situations where their emotions are getting the better of them can be quantified at 2% per annum in terms of the return increment that you end up saving them from making a silly decision.
And I think we saw this year the first instance of that became really apparent, which was, if we think about the market correction that happened on Waitangi Day, and it was lead on the news that evening, and we knew that as we came into work the next day, on the Wednesday, that the phones were going to be ringing off the hook, and they were. And there's a good reason for that, which is now balances are starting to get up to a level that a move in the markets of 1 or 2% is actually being reflected in people's balances going down. Historically, historically, balances were a lot more modest, and the weight of contributions on an ongoing basis often meant that even if there had been a negative market movement, the weight of contributions meant that the balance continued to go up anyway. So now people are starting to see their balances go down for the first time, and the question is, how prepared are they for that? We saw on that Wednesday after Waitangi Day that actually people were not prepared for it, and it's therefore our role as providers to respond to that. So we knew we had to have FAQs ready and have people ready to answer the phones at 8:30. We also knew that we had to get a comms out. So by early afternoon, that Wednesday afternoon, we had an email out to our members with a headline of "Don't panic." Just those simple, reassuring messages, reminding people that actually now will probably be the worst time to lock in those losses.
And I have to say, the challenge with that message is that it doesn't matter how many times I write it, people seem to forget it 5 seconds later, and I really see that. I mean, I sit in the business team at the Herald, but you know when it's the general section, they're constantly saying, well, you know, what should people do if there's a market downturn? And there's a constant, every time there is a downturn, there's a constant request for another story saying, well, what should people do? But the message is no different, right? It's still don't panic, don't, you know. But yeah, the general public does not understand that, and yeah, it is vital to sort of keep getting that message out, I think.
Yeah. Okay, so just in the interest of time, I think perhaps we'll move on to the third topic. So David, perhaps you'll like to take the lead on this.
Yeah, sure. Look, it's a topic that's very dear to our hearts right at the moment, and I'm not going to stand here and argue the case for why unlisted investments as an asset class are a terrific risk-adjusted alternative asset class for KiwiSaver investors. You don't have to be too smart to realise the opportunities in the New Zealand listed equity market are narrow at 35 to 40 companies you can realistically invest in, and they're priced on a PE ratio averaging around about 18 or 20 times earnings. You can explore and find within 20,000 small to medium-sized enterprises in New Zealand, and you can buy them for 6 times sustainable earnings. That's a third of the price. So the return proposition is very clear out there, and that provides a massive buffer. The issue, and Adrian touched on it this morning, it's just simply about risk assessment. Identify what are the risks in that asset class, price them, and then allocate them accordingly. And I think we've reached a time at the moment now where we no longer should be debating whether KiwiSaver funds should be utilised to support New Zealand enterprise or not. The answer is, of course we should. The focus now has to be on how do we go about doing that. And you just have to start doing it. We've started doing it. We've allocated $100 million so far to that space. When you start doing the proper risk analysis on all of the issues that we are all very familiar of, when you get into unlisted investments, of course they're less liquid, of course they're priced differently. But you do your analysis and you determine that you can easily accommodate that within a KiwiSaver space. Unlisted investments have been part of superannuation landscape for a very, very long time. They probably got a little bit too high at a third of the portfolios in unlisted property. But 5 to 10% of an allocation of KiwiSaver funds to an unlisted, less liquid space is very achievable when we know the cash flows that are coming through into the KiwiSaver space. For the 10 or so years we've been in business, we haven't had one single net cash outflow in any week. The cash flows are there, the time horizons are there, it's a long-term focus, the opportunities are there. Small to medium-sized businesses are screaming out for our capital. We just need to marry the two together. We've started the process. You can achieve solutions to the obvious problems that are out there. Unfortunately, I'll just have one final comment and then perhaps just hand this over. I don't believe the private equity space in New Zealand has done us any favours whatsoever. And I don't know whether there's anyone in the room who's in that space actively. I have been along to private equity meetings and they have said, why aren't you guys investing in us? And I've said to them, there's 2 reasons. 1, your fees are way too high. We can't buy into your funds at 2% plus a 20% performance fee. You've got to find a solution to that. Secondly, we don't need daily liquidity. We just need you to supply us with a daily price because we've got people who come and go in and out of our funds every day and we have to respect that and relate and reflect that in our prices. And they look at you funny saying, we can't give you a daily price. We revalue these things every so often. So the private equity space, if people are serious about helping us to get into that, they have got to address those two issues.
I'll go next. We've just had a conversation around the low level of financial literacy and understanding for KiwiSaver members generally around investing. So to me, the idea and the concept of investing in private equity any more than the small scale that exists at the moment is the very antithesis of KiwiSaver. The reporting doesn't exist. As you say, the unit pricing methodologies don't exist. They're very expensive. Most consumers just don't understand. They don't understand listed investments, let alone unlisted investments. So to me, the concept of broadening our responsibility to having to invest into private equity just doesn't work for New Zealanders and for KiwiSaver. I think it's way more suited to more sophisticated investors who are more aware of risks that go with it and more willing to put their money into investing into New Zealand Inc. As far as I can see now, most New Zealanders investing in KiwiSaver don't really care all that much ultimately around where their funds are going. There will be a debate about responsible investment, but the numbers are very, very small. They want a good return and they want to know that their money is safe. So investing in private equity to me is just too out there as regards KiwiSaver, which is of, as we've mentioned before, huge critical systemic importance to New Zealand.
Yeah, I think I would be cautious about it as well. I think possibly there is a place for some small amount of unlisted investment, but it does bring a higher risk. And I guess whilst it's nice to have a feel-good kind of let's invest in New Zealand Inc. approach, I think that the priority for somebody investing in KiwiSaver is to have a good sum of money in retirement. And, if that's going to put that at risk by investing in unlisted investments, then, we have to be very cautious about it. Perhaps it needs to be regulated, a cap put on the amount. I mean, not all fund managers would potentially have the experience or the ability to assess unlisted investments. So, maybe it has some small place, but I think there's got to be, caution taken around it. Definitely.
I echo exactly what Tamsyn was saying. I feel a little bit conflicted on this one. I feel like I wear two hats as a KiwiSaver member and as an adopted Kiwi, now a citizen over here. I feel intuitively this feels the right thing to do to support New Zealand Inc. However, as a KiwiSaver provider and as a fiduciary, our responsibility is on our members' long-term returns. And I have a number of questions that would need to be answered before you could even start to look at allocation in this space. And those are, what is the risk-return case for investment? What's the systemic risk premium that's available? How are we going to access it? Do we, as a manager, have the skills in order to fully utilise or capture that? What's the good quality deal flow that's coming through? What evidence is there? For this kind of space to be effective, you need top people going in and actually running those businesses. So do we have the top people available to actually turn those businesses around and build them up? What's the diversification impacts and how do you monitor that? But mainly, how will we get access to good deal quality, especially when we look at the other players in this space? You've already got NZ Superfund, ACC, NZVIF, all playing in this space. What will be available to all of us as KiwiSaver providers that actually would meet those criteria?
All very good questions, Joe. We have asked them all and answered them, and we're into it. When you ask yourself those questions and go through the proper risk analysis, the evidence that we looked into is compelling, and I would argue that it is a risk diversifier of significant proportions. I've spent my entire life focusing on alternative asset classes that diversify away risk. When you buy an unlisted New Zealand company that you know inside out, and yes, you have to resource up. We've spent millions of dollars hiring good people to do this. We can't just tack that onto the job description of one of our investment team. We've employed 4 people to focus on this. When you start looking at the risk assessment in terms of the reward, and you can buy a company for a third of the price in the unlisted space than you can on the listed space, that gives you a lot of buffer for downside risk. Some companies fail all of the time. Just because they're unlisted doesn't mean they're more likely to fail necessarily as a percentage. CBL, a listed company held in some KiwiSaver funds, it failed, it went to 0. Why is that not an issue? Because it's well diversified, so you've got to tick that box in the unlisted space as well. You can tick all those boxes. I just put the challenge out there. I just believe personally that we owe it to New Zealanders to connect their savings capital with New Zealand small to medium-sized enterprises, and 5 to 10% allocation out of $50 billion is $5 billion that we can put to bloody good use in this country, and 5 to 10%, when you do the analysis, does not compromise all of those things that you wrote through your checklist. So challenge is laid down.
I think you've made your business case, David. But I would finish by saying that, yes, all of those points are really relevant and valid, but are they valid for a government-supported superannuation scheme? So they may be valid for investment generally in New Zealand, but in a government-supported scheme where you've got innocent, largely innocent investors, is that appropriate?
We're de-risking their portfolios by including this asset class.
So there was a question that came up direct to this topic. So David, did the question you touched on earlier was, how do you get a price discovery in things that are not daily unit priced or daily priced?
Mm-hmm. Sure. I mean, that was certainly an issue. We try and keep things simple. When we look at buying a company on 6 times earnings, the key thing we're looking at is, and we're not talking about startups or venture capital here. Yes, we've allocated a little bit to the joint venture with Victoria University, but we're talking about buying into businesses that have got a clear and demonstrable track record of sustainable earnings that are for the most part, distributable. It's not difficult exercise to work out what your rate of return is going to be when you've got a business that's got a track record of delivering a profit profile, multiply by margin, give yourself, we're targeting somewhere around about a 15% return on investment. If we buy something for $10 million at a 15% return on investment because we can see they're going to deliver us and have done a sustainable dividend yield of 15%, then it's very simple to accrue a 15% daily accrual into your unit price. And you leave it at 15% divided by 365 days accruing into your unit price until you have some material information that tells you there is a significant change to the value of what that company is. And then you have to flow that through.
Good luck with that.
We're doing it, all right? We are doing it right now.
Right, okay. In the interest of moving things along, I think we've got about 10, well, perhaps a little less than 10 minutes, so maybe we'll go to some of the questions that have come through. Tamsyn, there's one here for you. What role does the media play in this discussion? Why can't media play an educational role rather than a focus on simplistic angles and headlines? A nice easy one for you there, Tamsyn. And welcome to the panel, by the way.
Thanks. Well, I think we do play an educational role, but I think if the sole focus is on an educational piece, we might find that not many people read it. So we have a dual role of not just education, but getting people to read what we write. So yeah, it's a balance, isn't it? Trying to do both, which is a challenge I face every day.
And what do people read? So what are the topics?
Well, I have to say, KiwiSaver is a very well-read topic. It attracts a large amount of interest online, but technical subjects don't. So it has to be put across simplistically, otherwise nobody reads it. So, we're targeting, we write for the general public, and so therefore, the level of knowledge is so low that, I could write about PIRs, but would people read that? I don't know. So it's that challenge, isn't it? I mean, I feel like I do my best to try and educate people, but yeah. If I write something that's totally dull and boring, nobody's going to read it anyway, so.
I think the bigger issue is not so much Tamsyn what you write, it's the small number of writers and the low level of debate in the media really around KiwiSaver and financial services generally. It's the same commenters and the same journalists all the time. It's a very small number, so I think it would definitely be worthwhile us having more people commenting in the media on different aspects.
Yeah, I mean, I guess that's the challenge. You've got a shrinking media. We're losing people all the time that are not being replaced, and so there is a small pool of us that write about that subject, and that's probably not about to change, unfortunately. But, if you have a view on KiwiSaver, do get in touch. Always welcome new voices.
So one of the other questions that's been touched on a number of times over the last couple of days, but is on the role of ethical investing or responsible investing, and the challenge being laid out: should all KiwiSaver schemes be required to do a level of ethical screening?
Yes.
I think. What does ethical mean? So are we going to have the Catholic Church coming in here and saying you can't invest in contraception and things like that? So ethics is really in the eye of the beholder in many instances. We have laws here that prohibit types of investments, which is really good. But at the end of the day, where we're at in terms of the level of sophistication is New Zealanders want the return that's going to give them their retirement that they want and they deserve. So I think choice is critically important, and people should be allowed to choose where they invest their monies. And to regulate funds that have to exclude ethical investment will take us many years to agree what that actually meant. And I just think it's not something that's necessary or desired by New Zealanders.
I think it's going to be interesting because the Minister last night referenced responsible investing in relation to the default provider review that's coming up next year, so it'll be interesting to see how that plays out. Tamsyn, I'm interested to hear your thoughts on responsible investing and what you hear from your readers.
Well, I guess when the Herald and Radio New Zealand exposed some of the investments that were in KiwiSaver funds, it created a huge uproar and obviously massive change across the industry, where we saw, funds pull out of, nuclear investments, landmines, all those kind of controversial things. But beyond that, I'd say that New Zealanders want to feel like they're doing good, but at the same time, I would agree that with Thérèse that they want to get a good return for their money as well. And it is a kind of personal thing, isn't it? What you perceive as responsible versus somebody else could be completely different. And at the moment, there isn't one set sort of rule across the industry. So, yeah, I think it's a kind of a grey area where, people are really concerned about those big issues, but whether it goes beyond that, I'm not really sure it does register with the public.
So I think it was touched on well in the really good panel yesterday on responsible investing, on obviously the spectrum of responsible investing, and one of the things I do believe is that there are a number of schemes out there that are holding themselves forth to be a responsible investor who are actually doing a pretty basic job of what most providers would consider to just be hygiene exclusions, and if you want to represent yourself as a responsible investor, you need to be going much further than that. But I think the key is around transparency, and actually being absolutely clear about what that means so people can make up their own minds. I'm just conscious of time and we're down to the last minute, and I know the topic was nominally how is KiwiSaver shaping up, so perhaps we should probably answer that question. So perhaps we'll start, David, with you. How do you believe it?
We've got 1 minute between four of us, so it's 25 seconds each.
Now 20.
It's not, it's 15. I've just tried to add a bit on. I've already lost 5. So look, just to finish off on the RI thing, I think this time, not next year, but certainly I would like to think that in 5 years' time, there's not one single KiwiSaver provider who's not a member of RIA and is been certified by them, in which case they probably do themselves out of a job, because everyone should be responsibly investing, and I've never thought that I was doing anything other than that for the entire 35 years I've been doing this. Summing up KiwiSaver in terms of shaping up, I think it's shaping up fantastically. I think there are massive opportunities. There are some caveats. For people who know how KiwiSaver works, it is brilliant. For those who don't, it's a minefield. And the challenge is for us to ensure that those people who don't know enough about KiwiSaver in all respects, which fund, what tax rate, what do I do when the market panics, if we give them the tools, then KiwiSaver is a brilliant vehicle for their long-term savings.
I would say very quickly, I've said it before, it's a good start. I would give it not achieve, but nearly achieve. 42% of people are not contributing. How can we say that it's working? It's certainly the contribution rates are nowhere near they need to be to give New Zealanders the retirement that they expect to get. So a lot of work to do, but a good start.
Yeah, that's right. I would agree as well that, you know, one of the big issues is from the outside it seems amazing, doesn't it? 2.7 Kiwis signed up to it, but so many aren't contributing, and then there's also that million that aren't in there. So, you know, and that's going to create huge disparity at retirement if we don't change that.
I'd echo all of that, but what I would note is I think we're just about to go into a period of quite considerable change in KiwiSaver, whether it's prompted by the review next year or whether it's prompted by advances in technology and robo-advice. I think we're going to see a significant change, including, as I mentioned earlier, compression of fees, more online services, and a greater drive for us as providers to drive engagement and provide a support from a financial capability perspective for our members. And that, I believe, is us time up.